Hi traders, and welcome to the next video in this course. In this video, we're going to be taking a look at the derivatives market. The derivatives market is fairly important when it comes to our analysis and understanding how the markets work. We may not trade derivatives on a regular basis, but we do definitely look at them almost on a daily basis, and they can act as a leading indicator at times for certain asset classes like equities and commodities. So what we're going to do is firstly understand what are derivatives, and then take a look at the two main types of derivatives that we tend to use and focus on a regular basis. So let's get straight into this video. And firstly, answer the question, what are derivatives? So a derivative is a contract whose value is derived, which is where the name comes from. The value is derived from another asset. So what does that mean? Think about an insurance policy or an insurance contract. If you take out home insurance, there's a few things that go into determining how much that policy is worth. How much of a premium do you need to pay? The first thing that the company is going to look at, the company giving you that insurance, how big is your house? What's the value of that house? What are the risks with that property? Is it very old? In which case, could you have some problems with the structure? Is it likely to collapse? They'll then take a look at where is it located? Are you located somewhere where there's regular flooding, or where there could be maybe hurricanes or some sort of extreme weather event? Once again, does that increase the risk of structural damage to the property? They'll then take a look at the contents in the house. What's the value of the contents? So all of these factors come into play, and that determines the value of that insurance policy. The value of the policy is going to be derived from the value of your house and the contents within the house, and then the other risks around it. And derivatives work in exactly the same way. And because of that, they often get used as a protection measure. So we'll understand this a little bit more in the next couple of slides, but just to give a quick example, as traders, we are able to get in and out of the markets very quickly because we have relatively small accounts. We're not trading portfolios of billions of dollars like a lot of hedge funds or pension funds, or even the big banks. So we can get in and out of positions very quickly. Now, with big funds, that's difficult for them, because if you try to sell billions of dollars of, let's say, the S&P 500 or US stocks at a certain time, chances are you're going to end up moving that market. You're going to cause a lot of volatility in that market. And if you've got other funds all trying to do the same thing, the market is not going to function properly. So it's not stable for the markets, but also it's not really possible for those funds that want to do it, because when they put an order in that's that big, the market is just going to react very quickly. The price is going to drop, which means that the initial portion of that position to sell will execute at the price they wanted. But once the price collapses, the remaining parts of that order will end up executing at much lower prices. So they actually end up losing out. So for this reason, pension funds, hedge funds, banks, any sort of big investment company, they have to think about their risk management. Now, we haven't discussed the risk management in a lot of detail, but I'm sure you guys will be aware of things like stop losses. That's the type of risk management we use on a regular basis, along with a couple of other measures as well. These investment companies, they've also got to take protection measures, but a stop loss isn't going to do the job for them, because, as I said, if the order is too large, the initial part gets executed at the right price, the remainder ends up getting executed at a much worse price. So the risk measures that they then use is they'll look at these types of derivative contracts or insurance contracts, where they pay a small amount for the contract, and it allows them to either lock in some profits or effectively place a stop loss on their position that is not going to disrupt the markets, and it's going to execute at the levels they are looking at. It's going to execute in the correct way. Now, you'll understand this a little bit more in the next couple of slides, but the thing you need to understand right now is that derivatives are often used as a protection measure. And because of that, when we see a high demand for certain derivatives, that indicates that maybe the markets are preparing for a fall in equities or maybe a certain type of market. So this is why they can act as a leading indicator as well. Now, along with providing protection or insurance, derivatives can also give investors and traders a different way to get exposure to certain markets. In the last couple of videos, we've talked about using equity sector indices or using bonds as a way to get exposure to certain trade ideas rather than just limiting ourselves to maybe FX. So options are another tool that we can add to the toolkit. Now, options, or rather derivatives, are another tool that we can add to the toolkit. Now, they are somewhat complicated. So like I've said before, start off simple. Start off with just FX. But understand that there are these other asset classes and they can be very, very useful if you understand them. But there is a process to go through to learn about how they work and to understand how to trade them. So it's not something you want to start doing straight away, but it's definitely something to incorporate later in your trading career. So derivatives can also provide us with that extra, or with an extra tool or an extra few tools really, to execute our trade ideas. Another advantage that we get from derivatives is that they can provide investors with a lot of leverage. Leveraged trading is very popular because it means you've got to put less money down to get a larger exposure. Now, obviously, that's risky as well, because although you can make more profits, you can also see magnified losses. You could end up losing more than whatever your initial deposit is in your investment account or your trading account. But in countries like the United States, where leverage is very, very limited on things like the FX markets, derivatives can be a very popular way to trade because it provides significantly more